basic concepts, constant and variables, dependent and independent variable, stock and flow, ex ante and ex post variable. Chapter 2, following the chapter 1, the building blocks, basic concepts in economic analysis. Prologue, the language of models. Economics, like any science, seeks to understand and explain complex phenomena. To do this, it uses models, simplified representations of reality. Just as an architect uses a blueprint to represent a building, economists use models to represent the working of an economy. These models are built using specific types of components, which are constants, variables, stocks, and flows. Understanding these components is akin to learning the alphabet before writing a sentence. It is the essential first step toward economic literacy. This chapter delves into the core concepts that form the vocabulary of both microeconomic and macroeconomic models, constants and variables, dependent and independent variables, stocks and flows, and the planning versus realized concepts of ex ante and post ex post. Section 2.1, Constants and Variables, the fixed and the changing. In any economic relationship, some elements remain unchanged while others are subject to change. This distinction is captured by the concepts of constants and variables. Constants A constant is a quantity or value that is assumed to remain fixed during a specific analysis or within a given model. It is a parameter that doesn't change. Purpose. Constants simplify models by allowing economists to focus on the relationship between key changing elements by holding other things constant. The assumption of ceteris paribus. We can isolate the effect of one specific change. Example in a model. In a simple model of a single market, the price of related goods or consumer tastes might be held constant to analyze the pure relationship between the price of a good and its quantity demanded. Variable available. Variable. A variable is a quantity or value that can take on different values during a specific analysis. Variables are elements that economists are primarily interested in studying because they change and interact. Purpose. Variables represent the dynamic parts of an economy, the elements that fluctuate and whose relationships we seek to understand. Example. In the same market model, the price of the good and the quantity demanded are both variables. They change in response to each other and to other factors. In essence, a model is a story about how variables interact with one another, framed within a world defined by constants. Section 2.2, Dependent and independent variables, cause and effect. When two or more variables are related, it is crucial to distinguish between cause and effect. This is the role of dependent and independent variables. Independent variable, explanatory variable. This is the variable that is presumed to cause or influence a change in another variable. It is a factor that is manipulated or changed first in the relationship. On a graph, it is typically placed on the horizontal, which is x axis. Think of it as the input or the cause. Dependent variable, explained variable. This is the variable that is presumed to be affected by or dependent on the independent variable. Its value depends on the value of the independent variable. On a graph, it is typically placed on the vertical y-axis. Think of it as the output or the effect. Illustrative examples. First, a microeconomic example. The demand curve. Statement: an increase in the price of gasoline leads to decrease in the quantity of gasoline demanded. Independent variable: price of gasoline, the cause. Dependent variable: quantity of gasoline demanded, the effect. A macroeconomic example: the consumption function. Statement: higher levels of disposable income lead to higher levels of consumer spending. Independent variable: disposable income. Dependent variable: consumption spending. I repeat that statement of macroeconomic example. Higher levels of disposable income lead to higher level of consumer spending. A critical caution: it is important to remember that this classification is based on the theoretical relationship proposed by the model. In reality, causality can be complex and bidirectional, a concept known as simultaneity. For instance, while investment influences GDP, GDP also influences investment. Section 2.3: Stock and Flow. The snapshot and the video. Perhaps one of the most vital distinctions in macroeconomics is between stock and flow variables. Confusing the two leads to profound misunderstandings of the economic data. Stock variable: a stock is a quantity measured at a specific point in time. It is an accumulated value, a snapshot of the state of affairs at a given moment. Analogy: the amount of water in a bathtub at 8 pm. Economic examples: wealth, the total value of your assets, house, car, savings on December 31st. This is a stock. Capital, the total amount of machinery, factories, and tools in an economy on January 1st. Public debt, the total amount of money owed by the government at the end of the fiscal year. Inventory, the number of unsold cars on a dealership's lot on the last day of the month. Units, it has no time dimension in its unit, that is just dollars, number of units. That is not that is. For example, uh, flow variable: a flow is a quantity measured per unit of time. It represents a process or rate of change, a video of activity over a period. Analogy: the rate at which the water is flowing into the bathtub between 8 pm and 9 pm. That is, for example, 5 gallons per minute. Economic examples: income, the amount of money you earn per month or per year. This is a flow. Investment, the amount of new capital added over the course of a year. Government budget deficit, the amount by which spending exceeds revenue during fiscal year. Production sales, production or sales, the number of cars produced or sold per quarter. Units, it is always expressed with a time period, that is dollars per year, units per month. The interrelationship: stocks and flows are intrinsically linked. Flows cause changes in stocks. The flow of water from the tap increases the stock of water in the bathtub. Flow of investment over a year adds the stock of capital at the end of the year. Flow of government budget deficit over a year adds to the stock of public debt at the end of the year. Key insight: you can only add a flow to a stock if they are measured over the same time period. You can only add a flow to a stock if they are measured over the same time period. It is meaningless to compare a stock from one point in time to a flow from different period. Section 2.4: ex ante and ex post variables, plans versus realities. This distinction is crucial in Keynesian macroeconomics, separates the economic world into what is planned or expected and what actually occurs. Ex ante, planned, intended, or expected. The term ex ante is Latin for before the event. Before the event. In economics, it refers to the planned, intended, or expected values of variables before the economic process has unfolded. These are the plans that economic actors, household firms, make at the beginning of a period. Nature. These are subjective, forward looking concepts based on expectations and intentions. Example, ex ante investment. The amount of investment firm plan to undertake in the coming year. Ex ante saving. The amount of saving households intend to do based on their expected income. Ex ante demand. The level of demand firms anticipate for their products. Ex post. Realized or actual. The term ex post is Latin for after the event. It refers to the actual realized or recorded values of variables after the economic process is complete. These are the outcomes that are measured in national income accounts. Nature, these are objective historical facts. They are what actually happened. Examples, ex post investment, the actual amount of investment that took place during the year, which includes both planned investment and unplanned changes in inventories. Ex post saving, the actual amount of saving recorded in the economy, by which national accounting identity must always equal by a national accounting identity must always equal ex post investment. I repeat, ex post saving and ex post investment. Okay. Nature, these are objective historical facts. They are what actually happened. Examples, ex post investment, the actual amount of investment that took place during the year, which includes both planned investment and unplanned changes in inventories. Ex post saving, the actual amount of saving recorded in the economy by which national accounting identity must always equal ex post investment. The macroeconomic significance. The divergence between ex ante and ex post values is a primary source of economic fluctuations in Keynesian theory. Scenario, suppose firms plan ex ante for a certain level of sales, but actual sales turn to be lower. Result, the unsold goods pile up as unplanned inventory accumulation. This unplanned investment means that ex post investment is greater than ex ante investment. Effect, this unplanned build-up signals to firms that they have overproduced, leading them to cut back on production and employment in the next period, potentially triggering a recession. The fundamental equality in national income accounting, ex post saving is always identically equal to ex post investment. However, ex ante saving and ex ante investment are made by different people with different motives and are not necessarily equal. It is the process of the economy adjusting to bring ex post results into line, often through changes in income and output, that drives the business cycle. Conclusion, foundation is led. Mastering these basic concepts, distinguishing a constant from a variable, a cause from an effect, a snapshot from a video, and a plan from an outcome, provides the solid foundation upon which all subsequent economic theory is built. They are indispensable tools for thinking like an economist. Okay, that's it for the topic number 2 of macroeconomics.